Hello everybody, welcome back. I hope you're doing well. This is David back with you. Right, so we have a new reading. Its official title is Case Study in Risk Management. It's for the institutions. Right, so yeah, we have a new reading, and the areas of risk we're going to have a look at will be particularly focusing on those illiquid investments like private equity, infrastructure, real estate and hedge funds. The kind of risk issues won't be brand new to you at all. Things like illiquid asset classes, and also one particular theme coming through is also ESG, guys, the environmental, social, bit of the climate risk and the governance risk coming in as well. So again, this is brand new. We have developed some new questions for you, but I hope this reading really helps get a good handle on what it's all about. I quite enjoy it. Okay, so looking at an overview of what we have planned for you. I think we have met before. If we haven't met for some time on the videos, guys, it's great to be back with you. Now, looking at the overview on summary of overview of this slide I've got for you here. This is focusing on institutions, so it's one of the two institutional case studies. There are two of them, two case studies. One of them is portfolio management, but this is the risk one, brand new. And I mentioned that I work in risk, and over the years, the kind of risk chapters in level 3, they have appeared in different places, but it's nice to see this one coming back a bit more in the forefront. Okay, so the big link, I suppose, I would say in this chapter is two alternatives, where you will find private equity, you will find infrastructure, real estate and hedge funds, and also quite a lot of discussions about different forms of investment, in that you could invest directly by buying probably a quite expensive property, real estate property, or you could invest indirectly via part of a fund, a real estate fund. Now, the premise of this reading, though, this case study, is mostly around direct investments, where you might be investing as the sole owner, but within the case studies we're going to see, you're actually part of some joint ventures as well. So when you bring in joint ventures, brings in a whole myriad of other issues, like control. Do you actually have control over the project? Are you having to work in partnership as more of a minority investor? I'm going to have a look at what it means to invest directly versus indirectly as a key theme in this first segment, this first module. Now, before you go ahead, you'd expect a tremendous amount of due diligence to be done. And so in the case study that you're going to end up with in our final module, our fourth of the 4 modules, there's a fair amount of information you're going to be provided with by way of background and due diligence information. Now, although we have around about 6 or so institutions, can you think for a moment of the ones that are missing? So I put up here pension funds, sovereign wealth funds, endowments and foundations. Which ones are missing that I've left out to in particular? So the ones that are missing are the insurance companies and banks, and so the whole main focus of this reading is on long term. Let's just highlight this one here, long term. Yeah, long-term investments rather than some of the short-term issues. We're thinking long-term investors are often are going to see 20, 25-year or more horizons. Now, the case study itself, though, that the chapter uses to illustrate these points, they've actually picked a sovereign wealth fund. But I think for the exam, any of those institutions would be fair game. But this particular case study we're going to have a look at is a sovereign wealth fund. Now, there are a few types of 5 types actually of sovereign wealth fund that we looked at in the institutional area, and the most long term of all of them would be a savings fund. And what we're going to see here is that a particular fictitious sovereign nation, that they discovered some valuable commodities, And the idea of transforming and transferring the wealth, not just from the perhaps the time period where the wealth was discovered, but also for future generations. So this idea of savings for the future, called a savings sovereign wealth fund. Now, as far as the key risks that the this new reading picks up on, first one's going to be illiquidity. You think about private equity, real estate, infrastructure, and also hedge funds as well. Hedge funds, very, very well known in terms of having lockups. This could be perhaps a 2-year lockup when no withdrawals are allowed. And even beyond that period, after the 2-year period might be up, talk about a gate. I always think about escaping from a penitentiary or a prison, that kind of thing. Escape plan, maybe, where you have to get out of the main building, being you kind of locked up. That's perhaps a 2-year lockup or lock-in. And then you've got to get over the perimeter fence or gate. That's the second notice period. Perhaps that might be 6 months as well. So what all these have in common, these alternative asset classes being very illiquid. The key focus guys coming in there, how perhaps at the same time when you really need the liquidity most, what if the market became quite illiquid and pressured at the same time? And we've had lots of time periods, certainly in the COVID pandemic period at the moment. This video is being recorded in September 2021, and the pandemic is still here. We're kind of 18 months into it. So this idea of market periods, whether it might be 2008 subprime, or whether it might be 1998 and long-term capital management, there are plenty of stressed periods where liquidity might be hard to come by. And all these institutions, guys, pension funds, sovereign wealth funds, endowments and foundations, the kind of keeping it real, I suppose, keeping it real is they all have objectives. They're all there for a purpose. Their job is to fulfill the needs of the beneficiaries that they are there to support, whether it's pension plan beneficiaries or whether it might be the nation, guys, future generations with sovereign wealth funds, endowment of foundation beneficiaries too. And so the impact of these downturns, the impact of these illiquid conditions affects their cash flows, affects their ability, and maybe even their very survival. And finally, there's a theme coming in, again, something that I'm quite interested in myself. The climate and the sustainability is an exam that I did in the last lockup period, guys, 2020. Around about a year ago, the new SCR, Sustainability and Climate Risk exam. So it's something that I'm quite interested in myself. So it's great to have the chance to talk a bit more about the ESG impacts, because they are an important theme in this new case study. And finally, a bit of risk theory. So enterprise-wide risk management theory is incorporated in this reading. And what we're talking about here, whilst there are many specialist areas and departments in any organization, thinking more about lending and credit risk perhaps, or investments and market risk, talked about liquidity risk already, operational risk perhaps. And so when you think about managing the risk overall, then you've got to think about how the synergies and how we think about more firm-wide risk management. And so we have some theory, and one of the learning outcomes that we have in this new area is for you to analyze and recommend some improvements. So we are going to incorporate some risk techniques and methodologies in here as well too. Okay, everyone ready to make a start then? Now, as a starting point, where I want to start here before we get into just a quick refresher of the institutions that you've seen before, is to think about what the aim of risk management is, which is to avoid, talks about this existential threat to the organization. Now, this threat could come from within, and it could come from the wider environment. Total risk has the systematic factors that can be from the external environment, whether it might be COVID being a sort of external threat to the whole organization, community, country, or whether it might be something from within, more to do with our product strategy, more to do with our the investments that we decide to take on board. So this chapter is focusing on these direct private equity infrastructure investments. Are we opening ourselves up to what kind of risks, and what kind of events then might jeopardize the ability to meet our objectives? For example, tying too much money up in illiquid investments may restrict the very cash flows that are essential to meet the needs of our organization. If we are perhaps the Harvard endowment and our whole objective is to fund this year's cohort of students, graduates, we don't want that being impacted in any way. Now, when you're looking at risk, one of the lessons of the 2008 subprime crisis, one of the key lessons is not to just think about perhaps normal, sunny, smooth running conditions, of course, in terms of the economy or in terms of the markets or in terms of anything really. Our whole operations got to be ready for when things might become more difficult, non-normal, and even as far as a crisis too. So it's very familiar territory here in September 2021. I haven't been into the office for 18 months, working from home. Maybe you have as well. So this idea of getting used to being resilient, that's a key theme coming in here. And the area of resilience here is, can we continue our activities as an organization, as a pension, as an endowment, as a foundation? Can we continue in the face perhaps of illiquid markets, illiquid investments? Now, to understand the context for our institutions, any of these could be the investor we're talking about investing in these private equity, for example, investments, pension funds, endowments, and foundations. Firstly, think about the nature there of pensions providing retirement income to members. Got to have the right level of liquidity available. And so the key risk, the inability to meet the contractual liabilities as required. Now, one of the most famous examples, real life examples of the whole chapter really that illustrates everything really quite nicely is the Harvard endowment back in 2008. And we've got a bit more detail coming up here, but we're going to see here firstly that they had a particularly high level allocation. Look at that, 55% within private equity, real estate, and hedge funds. If you compare that to traditional advice within the CFA syllabus, where they're kind of questioning certainly no more than 5 to 10% in this kind of area, then again we have to sort of look again at the endowment model. And we are going to do that shortly, looking at that a bit more detail. Again, one of the main ideas, of course, is that endowments and foundations here needing to get high real returns, particularly for those future beneficiaries. They're perpetual organizations looking to very much looking to take on that risk to get those real returns. However, if you are an endowment or a foundation, you have to be fair to both the current and future beneficiaries. Remember the term we use for that intergenerational equity. You've got to be equitable to both sets of beneficiaries. And so key risk here, the inability to be able to fulfill its whole mission and purpose. And if you are the Harvard endowment, that would mean perhaps having insufficient liquid funds to fund this year's students. So guys, we're going to come back to the Harvard endowment and look what happened and look what they did to solve that problem a little bit later on. Now, we talked a bit about liquidity, and one of the themes coming through in the chapter, talking about institutions in general, is that there has been a steady increase, guys, a steady increase in the allocation to illiquid assets over time. And I guess what's the reason for the chapter here? That the cautionary tale, really, that beware. And what they're suggesting here is these assets, like private equity, like real estate, and like hedge funds, they will not be available to you in a crisis. Let me just repeat that. They'll not be open to you or available to you in a crisis. So better have a plan in place. Moving on to the case study we're going to be looking at, which I mentioned is a sovereign wealth fund. Again, there are five sovereign wealth funds mentioned in the institutional investors reading, and some of them are the complete opposite of a long-term fund. I guess that would be the budget stabilization fund, especially where within a particular tax year, very, very short term, then the government involved may need extra support or funding from this budget stabilization fund. So, guys, we've covered those in the earlier session, but here we're going to just focus on the long-term savings sovereign wealth fund. And what we're going to see here, we're going to meet a fictitious sovereign country who have discovered valuable commodities. And the idea of saving these and transferring the wealth discovered perhaps today in the recent past, and investing that for the benefits of future generations. That's the main long-term goal. Now, there are a number of risks coming up in the case study, and just by way of a quick overview or summary, I've mentioned a few of them here. Well, we've talked about the natural liquidity risk, not being able to access the funds. One thing you need to be quite careful of here is to quantify the risk, quantify it. And what I mean by this, I'm just going to make a quick note here of this on quantify, is for you to really assess the scale of that. And a good tip when you are doing this is to compare the assets. Guys, compare the assets that are going to be invested in this way over the assets under management, and get yourself a percentage, if you like, because remember that this might be relatively small. So if it is a relatively small project, relatively small investment, and you look at the wider holdings we have, then although the private equity or infrastructure, etc., although in itself is quite illiquid, the fund itself might have very little problems because of the other liquid assets elsewhere. So remember that when you are judging or assessing, quantifying the liquidity risk, it's not the absolute number that matters. It's really the proportion within your overall portfolio. And that's a little trick the Institute like to play on you, trying to get you to consider the individual project on a kind of standalone basis, but actually you should be considering it as part of your overall percent of the portfolio. Mentioned about the environmental, just watch out for those, the environmental risks. More of those coming up in the next module. But look for any signs of, areas of natural beauty, any signs of pollution, any signs of impact on the environment. On the social side, again, we have readings coming up, a separate module on this coming up as well. But on the social side, look at the way, if we're investing abroad, for example, or investing in another company, look at the way in which we're treating the employees, whether it might be health and safety, whether it might be employment conditions, whether it might be the pay, because if there's any suggestion of malpractice or of taking advantage in any way, particularly in a developing nation, is that the sort of reputational impact that you want? So the cutting costs by investing in some sweatshop in some place abroad, that's not going to be fitting often with our risk profile or our desires. And so we are going to have a look at what we call the sustainability of what we're doing as well. That the idea of fair treatment, and we use this term fair and just. And the term a just transition, being fair and just, not just to our own employees, but within our whole supply or value chain, whether it might be suppliers, distributors, the whole chain of our network of how we do business, certain standards that we're looking to maintain. Quite a lot of ideas around due diligence. So one of the case study ideas is giving you a lot of information up front and asking you to pick up some clues about the risks that lie in the investments we're going to have a look at. We're going to be evaluating, guys, 2 different investments, one of which will be one's a private equity investment, and one's actually an infrastructure investment. These are the 2 separate projects that the case study looks at. Now, we have 2 institutions that don't form part of this reading, more short-term in nature, banks and insurers. So banks and insurers, not the main focus. All the asset liability management, of course, a lot in fixed income you've covered already. Not going to talk too much about it here at all. Same with insurance companies, banks and insurers, not the focus, not the long-term nature. So, but by way of a quick summary, what I've got for you here, the big 4, I think there are certainly questions possible with one of these 4 as the context. Does it really matter which of the 4 that comes in? Not really, because the chapter's talking a lot more about the content of the risks, irrespective of what the institutional investor. They're all long-term investors, not going to matter too much. But the context that we have is around about these areas: private equity, infrastructure, real estate and hedge funds. I think any of these are going to be fair game. The 2 I mentioned that are in the case study, the first 2, private equity and infrastructure. Now, looking at the case study that's coming up here, you're going to find that the time horizons here are typically going to be 20, 25 years. Long-term projects. Now, the one of the issues for us to explore will be: do we invest directly in this as a sole owner, or perhaps in a joint venture, or indirectly? And we're going to see indirectly through more an investment fund approach, more like as one of many investors in a fund. And we're going to see that the chapter particularly wants to bring out the risks when you invest more directly. So we're going to see lots of information, guys, coming up about the risks of investing directly. More of that in the next module coming up. And then finally, it's not just about kind of normal conditions, it's also all about the impact within a crisis as well, when liquidity particularly is going to dry up. And again, we can draw on our knowledge in other parts of the CFA program, guys, here. Well, one of them, for example, linking in here, is the idea of smoothing. Yeah, so the idea of our volatility of our returns, that they're going to be smoothed when we often have to use appraisal pricing, appraisal valuation. So the data that we're making decisions upon may well not be as good in this area, not going to be as current. A lack of transactions is the key problem compared to, say, equity markets where you have transactions all the time. So when you're making decisions based upon data, you've got to be aware that some of the data we're looking at could have inherent problems like the appraisal problem leading to smooth returns as well. Now, the whole purpose of these institutions, whether you own an endowment or a pension or a foundation, etc., is to have the cash flows when you need them, whether it's to pay a pensioner, a retiree, whether it's to make a make cash flows and spending as an endowment or a foundation. So the idea of looking at the impact on our business model is very important. And you'll see that Monte Carlo simulation appears a lot in this chapter as being one of the main tools. So Monte Carlo simulation, where you can look not just at normal scenarios, but also more at stress scenarios, factor in probabilities. That's the kind of preferred tool, especially over the long term. Lots of other risk techniques are more short term in nature. Monte Carlo simulation can handle the long term nature of what we're doing. And in the event of a really severe problem, our own survival, having enough liquidity to be able to continue in our operations. Now, we talked about Harvard as a great example of the endowment model. So I'm going to pick up on Harvard on this slide. I've added it in as I think quite a relevant little example here. But the book starts to bring up some of the risk considerations with illiquid assets in general. We can pick up on a bit of our institutional endowment model. Now, remember that the context in institutions is a university endowment. So I have brought in the Harvard as an example here. Now, with any endowment, often also foundations too, you've got the current beneficiaries. So with the Harvard as an example here, think about this in terms of current students, current benefiting from Harvard's courses and educational offerings. So the current cohort, there's got to be funding available to run the programs that you would expect that they plan and want to offer at the moment. And to be able to fund that, there's got to be a degree of stable cash flows coming through. But remember that the other beneficiaries, that Harvard exists not just for this current semester, current term, but also, I guess, for years and maybe even decades, hopefully, to come as well. So it's about the future beneficiaries too. And so the term that's used is the intergenerational fairness or intergenerational equity, being equitable or fair to both sets of beneficiaries. In the institutional material, it talks a lot about how we might have two slightly different objectives there. Number one, for the future guys looking for real growth, turning up the risk levels quite high, and we're turning the dial here into the illiquid asset classes like our private equity, our real estate, and our hedge funds. Take Harvard as our example here. Look at the weighting that Harvard had allocation-wise. Yeah, allocation there, 55% into these private equity, etc., which is very high. The endowment model is very high. Now, to try and handle the volatility that comes with this, smoothing rules or spending rules, the idea, for example, of thinking about your spending, whether it might be 5%, over the average, say, 3-year assets, trying to smooth down the volatility will help a lot with the consistency of the spending. So very often in the institutional area, you might be asked to recommend a smoothing or a spending rule, and you might recommend over, say, 3-year period to dampen down the volatility and give you a lot more consistency of spending year by year for the students. So that conflict in a way between growth and stability, the smoothing can help quite a bit. Now we're picking up though in this particular area on illiquidity, because along with volatility also comes the fact that it can be extremely illiquid, even in normal times. In fact, in a crisis, you might find it's going to dry up altogether. So this problem that Harvard had was quite a famous period of time in 2008, at the time of the subprime crisis. Now, one of the things the book is picking up on, guys, here, which is interesting, is how market risk and liquidity risk interact. And the idea of a crisis period can send asset values falling as well, and your assets can become illiquid at the same time. So this idea of a big fall, and that's exactly what happened with Harvard in 2008. So they had a 22% fall. That's just between July and October of 2008. That represents 8 billion of a fall. Now, Harvard were faced with some tough decisions. Here's the first tough decision they had to make. Number one, can we sell out, guys? Can we sell out some of these assets at a fair or reasonable price? Now, if it's not a fair price, guys, the expression often used something like, well, it's going to be a fire sale price or some sort of deep discount. Yeah, if the only way you can get out is some sort of a real fire sale or deep discount price, then don't do it. Don't do it. And that kind of liquidity is often called market asset transaction or even trading liquidity. When particularly in that time there, 2008 was the time of extreme kind of panic out there in the markets. There's no buyers at all, very few buyers. So if you can't sell the assets, we then have a second problem, a kind of link problem, which is what access do you have to other funds? And we call this funding liquidity. Now, this idea of using the portfolio you have by way of collateral to borrow against. It is a very common tool in the treasury function. Yes, so the idea of selling or borrowing against as collateral, and that's what Harvard did. They ended up requiring the liquidity to maintain their current operations, and they used their assets to borrow against. So having sources of funding, whether it might be credit lines or borrowing, having other sources, perhaps of the other assets that are liquid, and that's some of the ideas coming through later on is having a liquidity risk framework. Guys, the idea of managing liquidity much more closely and preparing. And one in particular, guys, here, a contingency funding plan. Some kind of a liquidity or contingency funding plan. That's where we're headed in our risk theory. And so to finish this slide off, an interesting quote I quite liked, which is to say that private equity, infrastructure, real estate and hedge funds, well, they won't be available to you in a crisis. In fact, they might not be available to you either, even in normal times. Long-term investments. Let's talk about something that you know quite a bit about from your CFA studies. Also in level 3 asset economics actually has it in there too. We have a little idea in economics mentioned briefly too here in level 3. But the idea of what do we mean by smooth returns and where do they come from? Well, if you compare more of a traditional asset class, guys, here, say equities or, I don't know, fixed income, well, you have lots and lots of transactions, and there's no real doubt about the price of something. It's pretty much a deep liquid market. When you compare something like real estate or private equity, for example, well, you might not have any transactions for years and years, and so the prices are stale, guys. Yeah, stale prices mentioned here. And so you're relying instead on appraised prices, appraisals. Now, another of the areas I get involved in terms of teaching, I also teach Kaya. And they're pretty, direct. Let's say it as it is. An appraisal, according to them, would be it's fake. It's a fake. It's not a real price, not a true price. It's a fake price. In that it's made up. It's made up. So, when you are making stuff up, it's a guesstimate. It's not necessarily going to be going to be accurate. So this concept of smoothing, where does it come from? It comes from relying upon appraisals. Now, what does that mean in terms of volatility of returns? Well, it means that the volatility is too low, guys. It's smoothed downwards. Yeah, and just to be aware of this, of course, that's the main idea, looking at the numbers and realizing what's happening here. So if we look at, say, the appraised upward market movement, the true market movement's probably going to be higher. We're going to get more of a rise than our appraisal suggests. Again, in a falling market, we're going to find that the true valuation is going to be even more volatile. And again, that the level of volatility is too low. So when you put these guys together here, the level of volatility here is too low. And you've seen that before in the alternative chapter, and we get it here as well. One little feature of this, which is testable just in case, is when you look at the overall portfolio as a whole. Let's focus on real estate as an example here, this segment alone. Now, let's say that real estate, again, hasn't had any transactions for a long time. We're relying upon a smoothed volatility. So guys, the return volatility, we know there is relatively smoothed and far too low. When you compare this then to the other asset classes that have actual transactions, and the volatility of those is normal, so it's going to be a lot higher. Well, this is the key point, that the correlation between these two looks falsely low. Now, why does it look low? Because the data's fake. With the smooth volatility, it's fake, right? So you're making decisions based upon incorrect data. So it looks like a low correlation. Bear in mind, guys, in real life, the correlations are much higher. So this point they're making here, that return and correlations there look falsely low. Correlations there falsely low. Now, when we think about then our asset classes, again, we're focusing, we mentioned, on private equity, on real estate, and infrastructure. For the case study that's coming up, private equity and infrastructure are the big two. And in both cases, the case itself of these two guys here, in both cases, is going to have a direct investment. And you're going to see here that in both cases, though, we are in some kind of a partnership with others. So although we're not in a fund, we are going to be kind of part owners, I would suggest, in this. And so this is quite important. When you, as far as the joint ventures go, I made a couple of notes on the bottom here. That well, we get a question, who you're going to be working with, who you're going to be there for quite a long period, perhaps as well. These also could be international investments, making that partnership even more tricky, even more difficult to manage. And that's the case as well. These are international investments in the case study. And so, the idea of risk managing our own firm, then the idea of risk managing a completely separate firm or working together, we could have very different management practices, very different cultures, very different views on which risks to take. In fact, it's wider than that. It's not even just the partner. You should also consider, guys, that the wider supply chains, often known as the value chain. Your distributors, your suppliers, you are relying upon them to deliver your product, to deliver to your customers. And if there's any part of that value chain has malpractices, is treating their employees badly, or has no gaping holes, then you're going to be associated as a firm with that. So that's why, guys, we've put reputational risk coming in here. And when you think of firms like manufacturing firms like Adidas and Nike, the idea of being called out, I guess, being called out for malpractice or using or and abusing employees around the world, particularly in developing countries as well. So this idea of if you're going to take out a joint venture, you need to do your due diligence and make sure that you're happy with the plans, the joint plans, if you like. Now, the business model in a joint venture, you'd certainly want a good say in that, wouldn't you? You wouldn't want to accept purely someone else's model without having any involvement, because you might spot certain risks, ways of doing things that you don't agree with, that you need to challenge and work together on. And so you'll find that in the case study coming up as well, that the planning and the due diligence that's going to be required here. There's lots of clues where risks might appear, and sure enough, in the case, we're going to see these risks do materialize. The case study also required to think in terms of entrepreneurship as well, and competition. The markets you're going into, is that the right time? What risks might be associated with that particular market? What are the local competition? You're going to be going to international waters, and developing markets as well. So got to think carefully about the local markets, the impact of other bigger competition coming in. And think kind of if you're going to be growing a business as an investor, as an owner, that idea of that entrepreneurship is going to be quite important. Now, if you are again in an international area, local jurisdiction and laws, and that covers things, anything really, from how to operate as a business, from your employment of employees and environmental issues, and taxes. Also, how are you treated as a international investor as opposed to a local company? For the local jurisdictions, by the way, be careful to look out for example, the government elections. You might find there's been a very advantageous, very friendly government in place. What if there was a new administration voted in that weren't so friendly? So you will see some clues like that as well about new jurisdictions, new administrations coming into power, maybe changing the whole field, making it less attractive as an investment. Then finally, the economy and the business cycle, the idea that you can have more like normal conditions, or there can be downturns and crisis. This has an impact, guys, on your numbers that you forecast. You forecast any new business, sales, customer numbers. Have you done sufficient stress testing to explore what would be the impact of a downturn? So, looking at, guys, at this direct approach coming in, what might be firstly some of the advantages coming in here? Firstly, number one, first advantage, you've got direct control over the asset. Now, this is especially important, I guess, for when you decide to exit. So, if you have direct control, you have greater liquidity, guys. You have increased liquidity because you can decide when you sell out. Whereas if you're in a fund, they might not permit any withdrawals at all or any exits for certain periods. So this is quite important, linking to the second one here, that the control you have actually gives you the control, the choice over the timing of exits. Now, a big chunk or lump of investment, quite a lumpy investment, makes it very tough to diversify across enough projects. Whereas if you were in a fund, guys, here we mean an indirect investment. Yeah, if you had chosen an indirect investment through a fund, well, you can spread your money across with other people's money as well, but much more diversified. Now, if you're the owner, part of an owner, you have unlimited. It's unlimited. Yeah, unlimited liability. And what I mean by this is if your firm is negligent in some of its operations and is sued, then you might find yourself with liabilities beyond your initial investment amount. Whereas if you invest in a fund, you can never lose more than your original investment. So this potential for carrying the can. We're going to see later on. I always think of BP and the deep water oil spill, and when you think about the liabilities that came in for BP there, and that was through mistakes from their contractor, guys, from their subcontractor. So the potential for additional liabilities from direct ownership it could be an issue. And then, of course, you've got to have the expertise, the in-house team, expertise coming in here as well. So just by way of a quick recap here, in the case you will be making direct investments, and all of these features are going to be important when we have a look at that. Now, if you contrast a direct investment more with an indirect investment, what we mean here is an investment via an investment fund, where you're one of many investors. Now, that can have a number of advantages. One of the main ones, I suppose, here is you're diversified. That you're diversified across many projects, reducing the specific or the idiosyncratic risks, which is good. And that can also be quite important for things like fraud, because if you have all your money with one manager or all your money with one project, that can be a problem. Be more diversified. Yes, you're also limited in your liabilities. The most you can lose is your fund investment, but it also has a number of problems. First one I'm going to mention down the bottom here, they call it the agency problem in CFA program, don't they, guys? I know you've heard of that before, the agency problem. In this particular chapter, they call it the principal and agent problem, whereby you're relying upon often an external fund manager. You have a bit of a distance between you and your investments. There's this kind of third party involved there, and also number two, the fees come in there as well. The base fee. So many of these areas, like infrastructure, private equity, hedge funds, you're having to pay for the expertise far higher than in traditional asset classes. So having this kind of fund management fee, if you like, and of course it's going to vary, mentioned in the text 2 and 20, we know it can vary a little bit, of course. In general, the trend tends to be lower fees, a little bit lower fees nowadays. But yeah, the kind of fund management fee on the beginning net asset value of the assets, and then sharing the profits as well above a minimum hurdle return. So things like this material straight out of the alts level 3, you've seen that before. Now, one of the key problems, though, with the indirect form of investment is it's not you has a direct say over when you leave a project, because you might find that you're restricted in your withdrawals. Guys, hedge funds have gates. Talked about gates and lockups. You might find that you have no say over it for a period. Whereas if you had a direct investment, you would be able to have a lot more operational control over when you decide to leave. Also, a direct investment avoids the principal agent issues. There's no third party manager involved. You're doing it all yourself. You're in control of it. Now, to finish off in this first module, first reading, guys, here, we're going to just introduce the idea of of how we're going to manage, what we're going to think about, how we're going to manage the liquidity risk that we've been talking about. And so this 5-step framework is really all about the tools and the framework used by an institutional investor here to manage the risk. Now, again, I mentioned that I'm a risk person. And so the idea of risk frameworks, where you always start at the top with the board, and we are doing the same here, whether it's a generic risk framework, a liquidity risk framework, start at the top, because it's the board of directors who really are responsible for the overall governance and ensuring that the organization meets the objectives in the right way. So the board needs to approve the policy and the guidelines and the framework there, and that's probably going to include some of these dimensions, the proportion that must be liquid. So Harvard, when you look back now, you might question, okay, well, what plans did they have in place for such a crisis period? What sort of other contingency plans did they even plan ahead for? And doesn't sound like that was as strong as it could have been. So the idea, guys, of having a certain proportion of liquid assets, having measured, monitored, planned daily and monthly cash flow availability, so you can maintain the organization's objectives daily, monthly, this is all pre-planned. Now, one of the because we're talking about private equity here, one of the features is the idea that the investments you might make as an investor, long-term investor, may call on you to invest over time. The capital's called at different stages. And so that's a real liquidity problem. If all of a sudden you get a capital call that you at the wrong time for you, the timing is not great, you don't have that liquidity available. So this issue, guys, of planning and tracking and having a process, that's also mentioned in this first stage here, that you're tracking and planning and you're forecasting, I suppose, the likely timing of any future investment capital calls. Now, in the event that things start to dry up, the event that your liquidity becomes shorter, you start to feel pressured in that way, that you should be alerted to that quickly with the key risk indicators, the liquidity triggers. And the idea of automating these is also mentioned, having a system, having it set up, having the reporting process. And in our next module, we'll look at the enterprise-wide risk management process that does have all those aspects of reporting, escalating in the whole process. Now, step number two, assessing current liquidity in normal conditions, crisis conditions, in those reports we were talking about before, reporting and escalating, there's monitoring as well, daily, weekly, having the right level of liquidity. So you got in the normal times we've talked about there, yes, that's fair enough, but also you'd expect to have in a crisis your contingency funding plan. That in the event that things do turn non-normal, that you've got some contingency plans ready. Now, we talked about some risk methodologies, and you're going to recognise these. But in the chapter in the reading that follows, when we get to the next modules or so, we're going to have a look at some very familiar risk techniques. And I mentioned the Monte Carlo simulations, probably one of the most useful ones to have up your sleeve and an answer. Because for all these institutions, whether it might be pensions, endowments or foundations, haven't they all got cash flows to pay out? They've all got cash flow to pay out. And so projecting ahead, not just over the next day, weeks or months, but looking ahead maybe even over years, simulating our asset values and our sources of funds for the uses of funds. We're going to need them. And very oftentimes, yes, you've got your kind of normal conditions being the baseline, and then thinking, guys, there about more stressed scenarios as well. Okay, so well, what are our sources of funds in those situations? And then maybe even going even further when our very survival or a real crisis is in here. I mean, we're currently in the COVID crisis, pandemic. So this idea of exploring how bad can get, different degrees of severity. The tool to write about, the tool to mention, will be our Monte Carlo simulation. Now, the projects that we do invest in the case study, well, you'll find that Monte Carlo simulation wasn't really used enough, and it could have been used a lot more to help understand possible scenarios, some of which actually happened. Yes, so stress testing, look at the Monte Carlo simulation to really help you there. And then finally, in the event of a crisis, well, there should be contingency funds plans in place. And as far as sources of funding goes, whether it's credit lines, whether it's like Harvard had to do, have the ability to be able to borrow in that way, but hopefully that within the portfolio, that there are more traditional sources of liquidity. One example here in the March 2020 COVID impact on the markets, a big outflow from investment grade bonds. So in real life, people looked at the most liquid areas to try and get their money out. Now, for CFA Level 3, don't need any market knowledge here at all. All the clues have to come from the case. But that's all we're saying here in this case here. Hopefully in your portfolio, look for any other more liquid sources of funds as well. Now, contingent funding is the first quick mention here. Other ones, contingent actions. It's the idea here, how might you act? How might you act differently now that liquidity is tight? And for example, spending might be one thing you can do. Review what spending to try and limit that, to try and see if we can protect some of our liquidity. Certainly other things you might do, rather than roll over investments, maybe you let them mature and have access to them rather than roll them over into longer term investments. And finally, have you got the right people in place? Have you got the right kind of training in place ready for this as well? Okay guys, that's the end of the first of the 4. The case study is coming in the last one, but we have got a couple more bits of theory to cover before we get there. In the next module, we're going to have a look a bit more at enterprise-wide risk management. So I'll see you back in the next module.